Duolingo investment research, target price, full valuation analysis, and Monte Carlo simulation by value and momentum portfolio.
Institutional-grade research on Duolingo with catalysts to watch and actionable insights for investing. Disclaimer: for informational purposes only, no investment advice. Duolingo, why now?
When you look at the numbers, Duolingo is objectively cheap right now, especially when you compare it to its own history and its peers in the sector. The stock has taken a massive hit, crashing minus 69% from its all-time high, yet the actual business grew its revenue by 39% just last year. At the current price of $104.84, you are essentially buying into a high-growth software company at a valuation you would normally see for a slow, mature utility company. The EV/sales multiple is sitting at roughly 3.76 times, which is the lowest it has been in years. And the free cash flow yield of 4.0% is actually 16 times higher than the 5-year average. The reason the market is getting this wrong is due to what I call a guidance lag. Wall Street analysts slashed their targets back in February because management was honest about 2026 being an investment year with a temporary slowdown in bookings growth to about 10 to 12%. The big error analysts are making is treating this deliberate strategic choice to sacrifice short-term profit for long-term dominance as a sign of weak demand. The street is completely missing the pivot to free flywheel, where removing friction from the app actually widens the top of the funnel. By reaching for that massive 100 million daily active user target, they are creating a much larger pool of potential subscribers for the future. Right now, the market sees Duolingo as a one-trick pony focused only on languages, which means several major segments are being assigned zero or even negative value in most financial models. For example, Duolingo Chess reached 7 million daily active users in under a year to become the second largest chess platform in the world, yet it contributes almost nothing to the current valuation. You also have billion learner markets in math and music that are being treated as free optionality, despite management calling the upcoming math app the best tutor in the world. On top of that, the company is a cash fortress with $1.0 billion in net cash and a $400 million buyback program, meaning that cash pile alone covers over 20% of the entire market cap. There is also a significant business transformation lag happening here. Duolingo has already made the leap from a cash-burning startup to a high-margin cash machine, but the share price hasn't caught up to that reality. Net income reached a record $42 million in the fourth quarter of 2025, and normalized free cash flow is now $196 million. The disconnect is that the stock is still trading as if the company is losing money or facing massive debt, when in reality, they have zero meaningful debt and a pristine balance sheet. Looking ahead, we have several time-bound catalysts that should force the market to reprice the stock very soon. The first is the first quarter earnings call on May 4th, 2026, which acts like a free call option because the CFO has already hinted that bookings are tracking above guidance. A modest beat there would immediately break the narrative that the company is stagnating. We also have the launch of Speaking Adventures in mid-2026, which will provide hard evidence that their AI investments are driving growth. Finally, as the company executes that $400 million buyback at these discounted prices, it will create a structural floor for the stock and boost earnings per share for the rest of the year. The market is pricing in permanent stagnation, but the operational data shows a company coiling for a massive multi-year expansion.
Company overview.
Based in Pittsburgh, Duolingo has grown from a 2011 startup into a global powerhouse that is practically the face of mobile learning today. Founded by Luis van Aan and Severin Hacker, the platform now offers over 250 courses that cover everything from Spanish and French to newer subjects like math, music, and even chess. They operate on a freemium model, which keeps the basic content free for everyone, while driving revenue through premium subscriptions like Super Duolingo and the more advanced Duolingo Max. Beyond those subscriptions, the company makes money through advertising and the Duolingo English test, which is a significant piece of their portfolio now accepted by over 6,100 institutions worldwide. What really sets them apart is how they use AI-driven analytics and heavy gamification. Think streaks and leaderboards to keep people coming back every day. They are sitting on a massive amount of data from the billions of exercises completed daily, and they use that information to constantly refine the user experience. Ultimately, they've positioned themselves as the leader in online language learning by focusing on their core mission to make high-quality education accessible to everyone, regardless of their background.
Product overview.
The real genius behind Duolingo isn't just the language lessons, but how they've flipped the script on traditional education. While legacy players like Babbel or Rosetta Stone try to force linguistic rigor from the very first minute, Duolingo focuses entirely on what they call an engagement-first paradigm. They realized a long time ago that the biggest hurdle in self-guided learning isn't the difficulty of the grammar, but the high dropout rate. By keeping lessons to a quick 2 to 5 minutes, they've made the cost of starting a session much lower than the psychological guilt of breaking a daily streak. It is essentially the only platform that has successfully mapped the dopamine loops we usually see in social media or mobile gaming directly onto educational outcomes, moving it from a niche academic tool into a true mass-market product. When you look at how the business actually makes money, it's a clever multi-tier system. The core language learning segment offers over 40 languages and runs on a freemium model where users either see ads or pay for premium features like Super Duolingo or the new AI-powered Duolingo Max. Then you have the Duolingo English Test, or DET, which is a massive disruptor. It's a high-margin $59 certification fee that is eating the lunch of legacy exams like TOEFL or IELTS, which can cost over $200. Beyond that, they are expanding into new verticals like math and music to capture more of a user's daily time, while their Duolingo for Schools program acts as a free top-of-funnel tool to hook younger users early. Under the hood, the technology is what really creates that competitive moat. They use a proprietary machine learning engine called BirdBrain, which predicts the exact probability of you getting a question right. It adjusts the difficulty in real time to keep you in that perfect Goldilocks zone where you aren't bored, but you aren't frustrated either. They have also leaned heavily into a deep partnership with OpenAI to power Duolingo Max, offering features like Explain My Answer and Roleplay that mimic a human tutor for a fraction of the price. By Q1 2026, their shift toward an AI-assisted content pipeline allowed them to publish over 20,000 new skills in a single quarter, which is a speed that competitors relying on manual teams simply can't touch. So, is this technology a sustainable advantage? I'd argue it is, mainly because of their massive data flywheel. With over 52.7 million plus daily active users, Duolingo is running more than 1,000 A/B tests every single quarter. They basically own the world's largest data set on how humans fail at learning, and they use that to optimize their models faster than any startup could dream of. Because they use AI for content generation and proctoring the DET, they can scale their student-to-teacher ratio to near infinity with almost zero marginal cost. While other apps might focus on deep recall or higher cognitive loads, Duolingo's tech is optimized for user longevity, and in a crowded app economy, staying power is the ultimate defense.
Moat analysis and competition.
When you look at Duolingo's position in the market today, the first thing you notice is that their moat is real, even if it's a bit narrower than what the peak stock valuation might have suggested. It really boils down to 3 distinct layers, starting with a massive data flywheel that is almost impossible to replicate. They see about 2 billion exercises completed every single day, which gives them the largest language learning dataset on the planet. More users lead to more data, which feeds better AI personalization, and that ultimately keeps people on the app longer. It took them 13 years to build this machine, and as the founder Luis van Aan has said, you couldn't just write down the specs and recreate this overnight. That data is backed up by a brand that has become synonymous with the category itself. Right now, more people search for the word Duolingo on Google than the phrase learn Spanish. That kind of dominance allows them to acquire users organically through memes and viral content, keeping their customer acquisition costs structurally low. However, we have to acknowledge that a mission-based brand is a double-edged sword. We saw this clearly with the AI memo incident in April 2025, which management admitted caused some unfavorable publicity and a temporary slowdown in user growth. It shows that while the brand is a powerhouse, it can be fragile if the communication around AI isn't handled perfectly. Looking ahead, the ceiling for growth still looks remarkably high. Internet penetration for their daily users is only at 2% in the US and 4% in Germany. If they can just get other markets to reach US levels of penetration, their daily active users would more than double. They are also moving into the $1 billion plus math market and expanding their English test, which already makes up about 4% of revenue. The strategy now is to move high-end AI features like role play and video call, with Lily further down the pricing stack as costs fall. While the 2026 plan involves a deliberate short-term profit sacrifice to prioritize long-term user growth, the underlying business remains resilient.
Pricing power.
Duolingo finds itself in a bit of a pricing paradox right now. They have this brand that gives them plenty of room to charge more, but they are intentionally keeping prices low to prioritize grabbing as many new users as possible. As we look at 2026, management has made it clear they are choosing growth over near-term profit. This strategy gives us a great look at just how resilient this business actually is. When you ask if they have true pricing power, the answer is a solid yes, but they use it selectively. Instead of just hiking flat fees, they use tier migration. A great example is the Duolingo Max tier. By adding AI-powered features like roleplay and explain my answer, they managed to boost their average revenue per user by about 6% back in 2025. Then you have the Duolingo English test. At roughly $59, it is the clear low-cost leader compared to legacy exams that cost over $200. This gives Duolingo a huge runway to raise prices in the future, while still being the most affordable option on the market. The demand for what they offer is also steady, even when the economy gets shaky. Education is a defensive sector, because when the job market weakens, people often double down on improving their skills to stay employable. While their gross margins are sitting at a robust 73%, they are actually planning for a slight dip in EBITDA margins to about 25% this year. That is a deliberate move to remove friction and hit their goal of 100 million daily active users by 2028. Their pricing power really comes from the psychology of the product. The streak system creates a huge sense of emotional lock-in because users don't want to lose the progress they've made over hundreds of days. This allows the company to introduce ads or limit features with much less churn than you'd expect. Plus, their scale creates a massive data moat. With over 52 million daily active users, every lesson makes their BirdBrain AI smarter, which keeps the product feeling like a game rather than work. Of course, there are still risks to watch. For the huge portion of users on the free tier, switching costs are essentially zero. They could easily jump to a free YouTube course or a basic AI tutor, which is why Duolingo has to keep engagement high rather than getting too aggressive with paywalls. They also have to navigate the 15 to 30% tax from Apple and Google, which is a permanent drag on their margins. Ultimately, Duolingo has what I'd call sleeping pricing power. They could tighten the paywall tomorrow and see a revenue spike. But for now, they are choosing to starve out the competition by keeping a best-in-class product mostly free to build a massive long-term moat.
Business performance.
MAU/DAU growth.
When you look at the growth numbers for Duolingo, you see a story that is shifting from pure scale to deeper engagement. Back in 2021, the platform had about 40 million monthly users and 10 million daily users, which put their engagement ratio at around 25%. That ratio held steady through 2022 as they grew to 15 million daily users, which was a solid 50% jump year over year. By 2023, things really took off with daily users hitting 26.9 million, a massive 79% increase that pushed their engagement ratio over 30.6%. The pace shifted slightly in 2024 as daily users reached 40.5 million, a 51% increase. while the engagement ratio climbed again to 34.7%. By the time we reached the end of 2025, they had 130 million monthly users and 50 million daily users, showing a 23% growth rate and an impressive 38.5% engagement ratio. Looking ahead at the 2026 estimates, management is guiding for about 60 million daily users, which works out to roughly a 20% growth rate. Now, the headline here is definitely the sharp deceleration in daily user growth, which has dropped from 79% to that guided 20%. But there is a very important quality signal hidden inside that quantity problem. Even as net new user growth slows down, the ratio of daily to monthly users just keeps rising. It has climbed from 25% to 38.5% over the last few years. What this tells us is that the existing users are becoming much more dedicated and engaged with the app. The total pie might not be growing as fast as it used to, but the people who are there are eating their slices much more enthusiastically.
Paid subscriber penetration and conversion rate.
If we look at how Duolingo is actually converting users into paying customers, the numbers tell a really interesting story about where the business is headed. Back in 2022, they had about 3.9 million paid subscribers out of 60 million monthly active users, which put their conversion rate at roughly 6.5%. By 2023, that number of paid subs jumped to 6.6 million, bringing the conversion rate up to 7.5%, though the implied annual revenue per subscriber actually dipped to $80.50. They kept that momentum going into 2024, hitting 9.5 million subscribers and an 8.1% conversion rate. Most recently in 2025, they reached 11.7 million paid subscribers, which means they are now converting 9.0% of their total monthly audience, while seeing that annual revenue per sub climb back up to $88.7. Now, on the surface, seeing conversion creep up from 6.5% to 9% looks like a clear win, but there is a major catch. Management has explicitly admitted that they achieved these gains largely by adding more friction to the app. They've been hitting users with more ads, tighter energy limits, and constant paywall nudges, rather than just relying on new features. This is a structural problem because friction-driven monetization eventually hits a ceiling and starts to hurt user growth. We are already seeing the bill come due with the daily active user deceleration in 2025. When you compare Duolingo to a giant like Spotify, which converts about 50% of its users to paid tiers, you can see the enormous theoretical upside here. Duolingo still has a massive opportunity to grow, but they have to find a way to win those subscribers over with genuine value rather than just making the free version harder to use.
ARPU evolution.
When we look at how Duolingo is actually making money from its users, the evolution of their revenue per user shows a company that is finally starting to flex its muscles. Back in 2022, the company brought in $369.5 million in total revenue, which worked out to about $94.7 per paid subscriber annually. By 2023, total revenue jumped to $531.1 million. But we actually saw the revenue per paid sub dip down to $80.5 as they focused on rapid user expansion. That trend continued into 2024 with total revenue hitting $748.1 million, while the annual revenue per paid subscriber bottomed out at $78.7. However, 2025 was a major turning point for the business because total revenue cleared the $1 billion mark for the first time, landing at $1,037 million. The most striking part of the 2025 data is that the revenue per monthly active user jumped by 24% year over year to $7.98. This tells us that their strategy of adding monetization friction really worked for that year. We also saw a significant rebound in the amount each paid subscriber contributes, which climbed back up to $88.7 as their premium max tier and new pricing strategies started to kick in. To put that in perspective, Duolingo is now earning about $88.70 per year from its paying users, which sits right in the middle between Spotify at roughly $72 and Netflix at about $180. There is definitely still room for Duolingo to expand those numbers, but the consensus is that they can only go so much higher by adding more value to the product, rather than just making it harder to use for free.
Duolingo English Test, DET, Volume and Adoption.
The Duolingo English Test, or DET, is probably the most underappreciated part of the whole business, but it's actually one of their most defensible revenue lines. Back in 2022, it brought in between $15 million and $18 million, representing about 4% to 5% of their total revenue, with 3,000 institutions accepting the scores. By 2023, those revenue numbers climbed to between $22 million and $26 million, and institutional adoption jumped to over 4,500. This steady growth continued through 2024, with revenue hitting roughly $30 million. And by the end of 2025, the DET reached $41.5 million in revenue, with over 6,100 institutions globally on board. What makes this so impressive is the sheer quality of the institutional lock-in they have built. Every single Ivy League school, plus MIT and Stanford, now accept the DET, and that includes 24 out of the top 25 U.S. universities for international enrollment. Because it costs between $49 and $65 per test, compared to over $200 for legacy exams like TOEFL or IELTS. Duolingo has created a massive competitive advantage. Once a university incorporates this into its admissions process, they rarely drop it because the switching costs for these institutions are very real. Even though the DET accounts for just 4.0% of total revenue right now, it is growing quietly at about 35% annually. There is a risk that tighter U.S. immigration policies could lead to fewer international students and fewer tests being taken, which management has explicitly acknowledged in their latest filings. However, having a network of 6,100 institutions globally is a formidable defensive moat that would be incredibly difficult for any competitor to replicate. It turns a simple test into a true B2B2C powerhouse that provides steady, high-margin cash flow for the company.
Streak Retention, LexP Efficiency Proxy.
When you dig into the operational side of the business, the streak retention data is arguably the most impressive thing in the entire dataset. As of the end of 2025, Duolingo reported that 43 million users have a streak of 7 days or longer. That means a staggering 86% of their 50 million daily active users have been on the app for at least 7 consecutive days, which is a level of consistency you almost never see in a consumer app. Even more shocking is the long-term data showing that 15 million people, or 30% of the entire daily user base, have used the app every single day for at least a full year. At this point, we aren't just talking about a simple product metric anymore. We are looking at a behavioral addiction metric. A 30% retention rate over 365 days is almost unheard of outside of massive social media platforms like Instagram or TikTok. It proves that once a user is hooked into the Duolingo ecosystem, they stay hooked for the long haul. This distinction is absolutely critical for anyone looking at the 2026 strategy. It tells us that Duolingo's current growth problem isn't at the bottom of the funnel, because they clearly know how to keep the users they have. Instead, the recent deceleration in daily active users is strictly a top-of-funnel issue with acquiring new people. If the company can fix that initial acquisition piece, the retention data suggests that the lifetime value of those new users will be incredibly high.
Organic Acquisition Efficiency.
When we look at how Duolingo brings in new users, their organic acquisition efficiency really highlights a massive structural advantage. In 2024, they spent $90.5 million on sales and marketing against $748.1 million in revenue, which means they only spent about 12.1% of their top line to grow. During that year, they added 13.6 million daily active users at an implied cost of just about $6.6 per user. To put that in perspective, a typical consumer software company might spend anywhere from 30% to 50% of its revenue on marketing. Duolingo has managed to stay at that low 12.1% level because their growth is overwhelmingly organic, driven by word of mouth and their viral presence on platforms like TikTok. However, the 2025 data shows that this efficiency is starting to face some real pressure. While they kept marketing spend at 12.1% of their $1,037.6 million in revenue, they only added 9.5 million daily active users. This caused their acquisition cost per daily user to roughly double to about $13.2. This trend lines up perfectly with the narrative that growth is decelerating across the board. The company is finding that as organic growth slows down, they have to lean harder on paid acquisition, and that simply costs more money. There were a few specific headwinds that really hurt the top-of-funnel quality last year. The brand damage from that AI memo incident in April 2025 definitely played a role, and management also pointed to changes in the TikTok algorithm during their latest earnings call. Essentially, the organic machine is still running, but it is just performing less efficiently than it used to. This is why their 2026 strategy focuses so heavily on reducing friction within the app. They are basically making a big bet that they can reactivate that natural viral word-of-mouth growth rather than having to go out and buy their way to a larger user base.
Financial performance.
Historical performance, annual and quarterly data. When you look at the historical performance of Duolingo, you're seeing a classic operating leverage story that is remarkable. If you go back to Q2 2021 and track it through Q4 2025, revenue has grown by 18 times. At the same time, the operating margin swung from a negative 45% all the way to a positive 15%. We've watched the company complete its profitability arc, with free cash flow turning structurally positive in 2024. Even with the 2026 guidance showing an EBITDA margin of about 25%, while they continue to invest heavily, it is clear the business is profitable enough to fund its own reacceleration. The numbers from 2022 to 2025 really tell the tale, with revenue climbing from $369.5 million to over $1,037.6 million. That represents a compound annual growth rate of 41.3%. While gross margins have stayed very healthy and stable around 72.2%, the real explosion has been in EBITDA. They went from losing $66.0 million in 2022 to bringing in a positive $150.0 million in 2025. This pushed their EBITDA margin from negative 17.9% to a positive 14.5% over that 3-year stretch. On the bottom line, diluted earnings per share shifted from a loss of $1.77 to a normalized gain of $3.49. Ultimately, Duolingo has proven it can scale its top line while maintaining high gross margins and generating significant cash. The company has moved from losing $35.0 million in free cash flow in 2022 to generating a normalized $196 million by 2025. While their total debt has increased to $93.8 million, the overall financial health of the business is robust. The market might be reacting to those quarterly earnings surprises, but the long-term trend shows a company that has successfully figured out how to turn massive user engagement into a self-sustaining, profitable machine. If you look at the business on a quarterly basis, revenue growth has actually stayed consistently strong, usually landing between 35% and 45% year over year. The real volatility has come from earnings per share. We saw 2 significant misses in Q4 of 2024 and Q4 of 2025 that triggered some major sell-offs in the stock. For example, in Q4 2025, the actual earnings were 84 cents against an estimate of $1.32. There was also a massive spike in Q3 2025, where earnings hit $5.95 against a $1.24 estimate, but that was a one-time tax benefit that actually coincided with a negative free cash flow of $221 million for that specific quarter. Cash flow and balance sheet health. When you look at Duolingo's financial health, the most striking thing is just how much cash this business generates. Back in 2022, they were actually losing $35.0 million in free cash flow, But they turned that around quickly to a positive $16.8 million the following year. By 2024, that figure exploded to $141.9 million, and in 2025, they brought in a normalized $196 million. What is impressive here is their free cash flow to EBITDA conversion. In 2024, it was in 193%, and it remained very strong at 131% in 2025. This shows working capital efficiency largely because their subscription model brings in cash from deferred revenue before they even have to provide the service. From a balance sheet perspective, the company is in a safe position. While their total debt has technically increased to $93.8 million, that is eclipsed by a massive cash pile. We estimate they are sitting on about $735 million in net cash. Even though their Altman Z-score dipped from a high of 21.0 down to 8.7, that is simply a technical byproduct of their growing earnings. Any score above 8.0 is considered exceptional, so there is virtually no bankruptcy risk here. Their current ratio has also stabilized at a very healthy 2.6 times, confirming they have plenty of liquidity to cover their obligations. When you compare Duolingo to its peers in the edtech space, the difference is night and day. Duolingo is a net cash company with a leverage ratio of negative 4.9 times, which puts them in a best-in-class category. Compare that to a company like Chegg, which is essentially distressed with over $700 million in net debt and a leverage ratio above 8 times. Even Coursera, while holding about $600 million in net cash, is still struggling with unprofitability. Duolingo doesn't have a formal credit rating from the major agencies, but that is actually a sign of strength. They have never needed to issue rated debt because they don't need external financing. Ultimately, Duolingo has built a fortress of a balance sheet. They are generating over $200 million in normalized annual free cash flow while sitting on that $735 million net cash cushion. They are so confident in their capital position that they recently authorized a $400 million buyback to return money to shareholders. While competitors are either burning through their cash or struggling under heavy debt loads, Duolingo is in the rare position of being able to fully fund its own growth and share repurchases purely through its own operations. Financial forecasts. When we look at the long-term roadmap for Duolingo, the bull case is really anchored by the ambitious targets management has set for 2028. They are aiming for 100 million daily active users and about $2.5 billion in revenue with $700 million in EBITDA. After bringing in $1,037.6 million in 2025, the company is guiding for a bit of a transition in 2026, with revenue expected to hit $1,208 million. This represents a temporary slowdown to 16.5% growth as they reinvest in the product. However, if the strategy works, we should see growth re-accelerate to 32.4% in 2027, with revenue eventually climbing to $2,850 million by 2030. The real story here is the expansion of margins and earnings power. We expect EBITDA to double from $150 million in 2025 to $302 million in 2026, which effectively shifts the EBITDA margin from 14.5% to a much healthier 25.0%. As the business scales toward that 2028 goal, those margins should stabilize around 28.1%. This flows directly down to the bottom line, where diluted earnings per share are forecasted to grow from $3.49 in 2025 to roughly $4.23 this year, potentially reaching $13.50 by the end of the decade. Free cash flow is expected to remain a primary strength throughout this period. While the margin might dip slightly to 16.6% in 2026 due to heavy reinvestment, the actual cash generated should grow steadily from $196 million in 2025 to about $570 million by 2030. This consistent cash production is what allows the company to fund its own growth without needing external capital. Of course, there is a credible bear case that we have to consider, and it is where much of the analyst consensus currently sits. If the 2026 plan to remove friction fails to bring in new users, the company could fall back into a much slower growth path. In that scenario, revenue might only reach about $1.5 billion by 2028, with EBITDA closer to $400 million. The market is essentially waiting to see if this 2026 reset actually triggers the reacceleration management is promising before they buy into those higher targets.
Second, derivative analysis.
Market share evolution and operating margins.
The market share data shows a level of dominance that you rarely see in tech. Duolingo currently controls about 85% of the daily active users in the language learning app category globally. If you look back to 2020, they held about 80% of a much smaller market, and they've managed to maintain that 85% share even as the total universe of language learners has grown significantly. CEO Luis von Ahn recently confirmed that this share has remained pretty flat for several years now. While some might want to see that percentage move even higher, it is actually a sign of a very healthy business model. Duolingo isn't facing erosion from competitors, but they also aren't having to fight expensive price wars for market share gains. Instead, the real value creation is coming from the fact that the entire market is expanding, and Duolingo is capturing the lion's share of that growth simply by maintaining its lead. When you look at Duolingo's operating margin over the last few years, the rate of change tells a story of a company that has moved remarkably fast from deep losses to steady profitability. Back in 2022, the average operating margin was a negative 17.5%, but they saw a rapid recovery in 2023 as that number climbed to negative 2.9%. The real inflection point happened in 2024 when they finally moved into the black with a positive 8.5% margin. And by 2025, that figure continued compounding to reach 12.9%. We are seeing the rate of improvement start to decelerate from those early jumps of 14.6 percentage points, down to about 4.4 percentage points, most recently. But that is actually quite normal. The easy gains from simply eliminating massive losses are behind them now, and the next leg of growth requires deeper product leverage, which just takes a bit more time. Looking ahead to 2026, we expect a bit of a plateau with GAAP operating margins landing somewhere between 12% and 14% as the company enters a deliberate reinvestment year. However, the long-term structural trajectory remains very much intact, and management is still targeting a move toward 15% to 18% by 2028. This temporary pause in margin expansion is a strategic choice to fund the next phase of the business, rather than a sign of underlying weakness.
ROIC and ROE, historical evolution and projections.
When you look at Duolingo's return on capital, the story is about a very clear, positive direction, even if the current numbers look a little modest. Back in 2022, the company's return on invested capital, or ROIC, was actually negative at minus 2.7%, and its return on equity sat at minus 2.8%. By 2023, those metrics finally crossed into positive territory at 0.6% for both. That steady improvement continued through 2024 and into 2025, where the normalized ROIC reached 3.7% and return on equity hit 3.9%. This represents a total improvement of about 6.4 percentage points over a 3-year span. Now, a 3.7% ROIC is still technically below what we'd call an average quality threshold, which usually sits between 5% and 8%. It is certainly a long way off from the 15% plus returns you see from truly elite companies. Part of the reason these ratios look suppressed right now is that the equity base is still inflated from IPO proceeds and stock-based compensation, even though the underlying profitability is getting much better. The real excitement is in the forward projections, because the trajectory isn't just moving up, it is actually accelerating. If the 2026 reinvestment strategy pays off, we expect to see a structural jump in ROIC from that 3.7% level all the way to somewhere between 10% and 12% in just 1 year. This happens because EBITDA margins are expected to expand to 25% while the company's earnings start to grow much faster than its equity base. Looking further out, the numbers get even more compelling. By 2027, we're forecasting an ROIC of around 14%, and by 2028, it could potentially hit 18% to 20%. That would officially push Duolingo out of the below-average category and straight into elite territory for return on capital. While the current snapshot shows a company that is still finding its footing, the multi-year trend suggests that Duolingo is on the verge of becoming a high-quality business.
FCF/net income ratio, the quality signal.
When you evaluate the quality of a company's earnings, one of the most important signals to watch is the relationship between free cash flow and net income. This ratio essentially tells you if the cash coming into the bank is actually matching up with what the company reports on its bottom line. Back in 2022, both numbers were negative, making the signal a bit noisy. But we saw a major shift in 2023. That year, free cash flow hit $16.8 million, while net income was only $12.1 million, giving us a ratio of 1.39 times. This was the first clear sign that cash earnings were starting to outpace accounting earnings. Things reached an exceptional peak in 2024, where the ratio climbed to 1.88 times. During that year, the company generated $141.9 million in free cash flow against $75.5 million in estimated net income. This massive gap was largely driven by a buildup in deferred subscription revenue, which is a structural tailwind for a business like this. By 2025, the ratio settled into a very strong 1.35 times, with $196 million in cash flow and $145 million in net income. As we look at the projections for 2026, we expect a healthy ratio of about 1.13 times, representing roughly $200 million in free cash flow and $177 million in net income. What this steady performance tells us is that Duolingo's earnings quality is incredibly high. We are seeing a natural normalization from that 2024 peak down toward a 1.0 times ratio by 2027, which is exactly what you would expect as a subscription base matures and revenue recognition begins to catch up with bookings. Whenever you see a software as a service business consistently maintaining a ratio above 1.0 times, it signals that the accounting earnings are actually understating the real cash generation of the business. Duolingo isn't just profitable on paper. It is a cash-generating machine that is performing well above the average company, and that trend is forecasted to remain strong for the foreseeable future.
FCF yield, current versus 5-year average.
When you look at the free cash flow yield for Duolingo, the numbers tell a story of a massive disconnect between how the business is performing and how the market is pricing it. Back in 2021 and 2022, the yield was actually negative, at minus 1.1%, as the company was still burning through cash. We saw it finally cross into positive territory in 2023 at 0.3%, and that climbed to 1.4% in 2024 as they generated $141.9 million in free cash flow. By the end of 2025, with free cash flow hitting $196 million and a market cap of $13.3 billion, the yield sat at 1.5%. Over the last 5 years, the average yield for the stock has been a very modest 0.2%. Fast forward to today in April 2026, and the situation has shifted dramatically. While the business is still generating that same $196 million in cash, the market cap has plummeted to just $4.9 billion. This has pushed the current free cash flow yield up to a remarkable 4.0%. To put that in perspective, that is 20 times the 5-year average. This spike is almost entirely a function of the stock, collapsing over 81% from its peak, while the actual cash generation of the business continued to accelerate. The market is essentially paying less for Duolingo's cash flow than ever before, even though the company is more productive than at any point in its history. Looking ahead, the yield is expected to remain very attractive, forecasted at 4.1% for the rest of 2026, based on $200 million in cash flow. By 2027, if they hit that $280 million target, the yield jumps to 5.7% at today's valuation. From a statistical standpoint, this is the most extreme free cash flow yield moment we have seen since Duolingo went public. The business is generating record amounts of cash, but the market is currently applying its most pessimistic price tag to date.
Full valuation case.
Valuation summary. When we look at the valuation for Duolingo, there is a fascinating gap between what the technical models suggest and where the market is currently trading. If you look at our various discounted cash flow models, the numbers are consistently higher than the current price of $104.84. In our bull case, we see a fair value of $172, which represents about 64% upside, while our base case lands at $149, or roughly 42% higher than today's level. Even when we apply a probability-weighted DCF to account for some uncertainty, we still arrive at a fair value of $130, which is a 24% premium over the current stock price. Other valuation methods tell a similar story of a stock that appears undervalued. A sum of the parts analysis gives us a fair value of $138, and a conservative reverse sum of the parts model suggests the stock should be worth at least $125. On the other hand, the Wall Street consensus has moved much closer to the current price, sitting at about $106 after the recent reset. It is essentially saying the stock is fairly valued right where it is. The only scenario that really justifies the current $104.84 price tag is our bear case of $93, which would require growth to stall out completely and the company's competitive moat to start eroding. When you weigh all of this together, the asymmetry clearly favors the upside. You have a company with 85% of its category market share, over $1.09 billion in cash, and a massive $400 million buyback program in place. Every fundamental model we use, from the base case DCF to the sum of the parts, suggests a value somewhere between $125 and $172. Unless you believe the most pessimistic bear case is the most likely outcome, the current valuation looks like an attractive entry point for a business that continues to dominate its space. Trading multiples. When we look at how Duolingo is trading relative to the rest of the market, the numbers suggest a massive disconnect between its growth and its current price. Right now, the stock is sitting at $104.84, which gives it a market cap of roughly $4.9 billion. But when you strip out that $735 million in net cash, the enterprise value drops to about $4.17 billion. For a company that brought in $1,037.6 million in revenue last year, while growing at 38.7%, those multiples are starting to look very interesting. If you compare Duolingo to a giant like Meta, you see something truly anomalous, because Duolingo is growing nearly twice as fast as Meta while trading at a very similar normalized PE ratio of 30.0 times. It also stands head and shoulders above its direct edtech peers like Coursera or Udemy, maintaining gross margins of 72.2%, which are about 15 to 20 percentage points higher than the rest of the sector. Even when you look at the social platforms like Pinterest or Snap, Duolingo's 4.0% free cash flow yield is actually more attractive than Meta's 3.4% and far better than Snap or Coursera, which are still posting negative numbers. Ultimately, Duolingo is trading at a lower enterprise value to EBITDA multiple than Spotify, yet it has higher gross margins and faster revenue growth. While Meta is the only company in this peer group with a richer revenue multiple, you have to remember that Meta has twice the operating margins and 10 times the scale. For a company like Duolingo to be growing this quickly while maintaining a fortress-like balance sheet and such a low PEG ratio, it suggests that the market hasn't yet caught up to the actual earnings power of the business. PEG ratio analysis. When we look at Duolingo's PEG ratio, the numbers tell two very different stories depending on whether you are looking through the rearview mirror or through the windshield. Right now, the trailing 12-month PEG ratio sits at 1.41 times, which uses a 30.0 times PE and a 21.2% growth rate for the 2026 fiscal year. At first glance, that looks like a fair valuation for a tech company, but that metric is essentially stuck in the past because it includes some of the depressed earnings figures from late 2024. The picture changes dramatically when we look at the forward-facing data. If we use the estimated 2026 earnings as a base and look toward the 53.7% growth reacceleration expected in 2027, the forward PEG ratio drops to just 0.46 times. Even if we take a more conservative long-term growth view of 20%, the forward PE of 24.8 times still results in a very reasonable PEG of 1.24 times. Ultimately, finding a forward PEG of 0.46 times is incredibly rare for a company of this caliber. We are talking about a business that maintains 85% market share in its category and 72% gross margins while sitting on a clear path to reach a 22% return on equity by 2028. For a dominant player like Duolingo to be trading at a point where you are paying less than 50 cents for every $1 of expected earnings growth suggests the stock is currently anomalously cheap. EV/EBITDA versus EBITDA margins regression. When we run a regression analysis comparing enterprise value to EBITDA against actual margins, we start to see exactly how the market is mispricing Duolingo. Right now, looking at the trailing 12-month data, the company has a 14.5% EBITDA margin and trades at about 27.8 times EBITDA, which is a slight 7.8% premium compared to its peers. However, the picture shifts dramatically when we look at the 2026 estimates. Management is guiding for EBITDA margins to jump to 25.0%, and at that level, the regression suggests a fair multiple would be about 21.3 times, yet the stock is currently trading at a forward multiple of just 13.8 times. That represents a massive 35% discount to where the stock should be valued based on its upcoming margin profile. If we look even further out to 2028, where management is targeting a 28.0% EBITDA margin, the disconnect becomes even more extreme. At those levels, the fair value multiple should be around 20.1 times, but the current stock price implies a multiple of only 7.1 times, which is a staggering 65% discount. It is clear that the market is currently only pricing Duolingo based on where it has been rather than where it is going. This regression shows a classic value recognition lag, as investors haven't yet factored in the massive margin expansion trajectory that is already well underway. Sum of the parts, SOTP analysis. When you break Duolingo down into its individual business units, you start to see that the whole might actually be worth much more than the sum of its parts. We look at this through a sum of the parts analysis, assigning different multiples to their three distinct revenue streams based on how they actually perform. The core subscription business makes up 79% of their revenue, bringing in $820 million last year with an expected $955 million next year. Because this is a high-quality consumer software-as-a-service model with 72% gross margins and 38% growth, we apply a 5.0 times sales multiple. That alone puts the enterprise value of the subscription segment at $4,775 million, which is right in line with how the market values companies like Spotify. Then we look at the advertising and testing segments, which add layers of defensive value. The in-app advertising brings in about 17% of revenue, and by applying a conservative 2.5 times multiple to its $212 million in next year's sales, we get a value of $530 million. But the real standout is the Duolingo English test, or DET. Even though it is only 4% of total revenue, it is a high-margin, defensible powerhouse accepted by 6,100-plus institutions and growing at over 30%. Because of that institutional lock-in, it deserves a premium 8.0 times multiple, giving it an enterprise value of $432 million. When you add those operating values together and include their $735 million in net cash, you arrive at a total equity value of $6,472 million. That works out to roughly $138.49 per share, which is a solid 32.1% higher than the current stock price of $104.84. The most interesting part of this calculation is what we didn't include, which essentially gives investors several free lottery tickets. Reverse sum of the parts, SOTP analysis. When you strip away the market noise and actually look at the math, Duolingo presents a classic buried asset story. We can see this through a reverse sum of the parts analysis, which essentially asks a very simple question: what is the market actually paying for the business today versus what we know those individual pieces are worth? To start, let's establish the current enterprise value. At a stock price of $104.84, the market cap sits at $4.9 billion. When you factor in about $94 million in debt and a massive $1,094 million in cash, the true enterprise value is only $3.9 billion. That is a critical number to keep in mind. The market is valuing this entire global ecosystem, the language app, the English test, and every new vertical at just $3.9 billion. Now let's break that down by valuing the segments using deeply conservative multiples. First is the core language learning subscription business. This is a dominant global player with 85% market share. Even if we apply a 15 times multiple to its $246 million in adjusted EBITDA, which is a massive discount compared to a peer like Spotify, that segment alone is worth $3,690 million. Next, we look at the advertising segment in the Duolingo English test. If we value the ad business at a modest 8 times multiple, it adds $352 million. The DET is even more impressive, accepted by over 6,100 institutions. Applying a conservative 15 times multiple to its $19 million in adjusted EBITDA gives us another $285 million. When you add these known established segments together, you get a combined value of $4,327 million. This leads to the most startling finding of the entire analysis. If the known parts of the business are worth $4.33 billion, but the market is only charging you $3.9 billion for the whole company, the market is essentially implying a negative $427 million of value for everything else. This means you are getting every new high-growth product for absolutely free. You're getting Duolingo Chess, which hits 7 million daily users in less than a year, the upcoming math app, and the music vertical at a negative price. In fact, the market is giving you a discount on the core business just to take those new assets off their hands. There are 3 structural reasons why the market is mispricing this so badly. First, analysts overreacted to the 2026 guidance reset, focusing on a single investment year rather than long-term growth. Second, a one-time negative cash flow item in late 2025 has distorted the screens that quant funds use, making the financials look worse than they are on a normalized basis. Finally, these new products like chess and math don't have their own lines in the P&L yet. They only exist in CEO commentary, so most financial models simply assign them 0 weight. You are buying a high-quality moated compounder at a price that suggests its growth has already stalled, even though the operational data shows the exact opposite. DCF analysis. When we sit down to model the actual value of Duolingo using a discounted cash flow analysis, we have to look at several different paths the company might take over the next 5 years. To keep our baseline grounded, we are using a 10.0% weighted average cost of capital and a terminal growth rate of 3.5%. With those numbers in mind, we've mapped out 4 distinct scenarios, ranging from a full-blown bull case down to a deep bear scenario. In the bull case, which we give a 25% probability, management hits those ambitious 2028 targets. This would see free cash flow grow from $210 million in 2026 to $590 million by 2030, which prices the stock at about $171.93. Our base case is a bit more conservative, assuming a moderate reacceleration of users. We give this path a 40% probability, projecting free cash flow to reach $505 million by 2030. That gives us a fair value of $149.47, which is a 42.6% upside from where we are today. On the flip side, we have to account for the risks. The bear case assumes the 2026 strategy fails and growth stalls out. leading to a fair value of $93.11. Then there is the deep bear scenario, a 10% outlier where AI completely disrupts their competitive moat and cash flow actually shrinks over time. That would drop the value to just $40.50. However, when you weight all these outcomes by their likelihood, you arrive at a probability-weighted fair value of $130.10. That suggests the stock is currently undervalued by about 24.1%. If you play with the discount rate and the growth assumptions, you'll find that the current price of $104.84 is only supported if you use a 12% discount rate and a tiny 2.5% terminal growth rate. That is essentially the most pessimistic sell in the entire grid. For a company sitting on $1.0 billion in net cash with zero debt risk, a 12% cost of capital is incredibly extreme. At any reasonable range, the fair value sits between $134 and $213. This really drives home the point that the market is currently pricing Duolingo as if the absolute worst-case scenario is a mathematical certainty. Reverse DCF analysis. One of the most effective ways to understand Duolingo's current valuation is through a reverse discounted cash flow analysis. Instead of trying to predict the future, we look at the current stock price of $104.84 and ask what kind of growth the market is actually demanding to justify that number. Right now, the market is pricing the company as if its normalized free cash flow of $196 million will grow at just 6.4% per year over the next decade. To put that in perspective, every single benchmark we have is significantly higher than that hurdle. Duolingo's actual free cash flow growth last year was 38%, and its 3-year average revenue growth is 41%. Even if you look at management's own targets for 2028, they imply a growth rate of 27%, which is more than 4 times higher than what is currently baked into the stock price. If you look at different growth scenarios, the potential upside becomes clear. If the company simply stagnates at 5.0% growth, the stock is worth about $96. But if they hit a modest 10.0% growth rate, the fair value jumps to $130. And at the industry average of 15.0%, the stock should be closer to $180. If they even come close to management's 27.0% targets, you're looking at a fair value north of $340 per share. Even if we use a punishing 12% discount rate, the market is still only expecting 10.5% growth, which is still a far cry from their historical 38% rate. The main takeaway here is that the hurdle for investors is incredibly low. The market is pricing in near-permanent stagnation, which creates a very attractive risk-to-reward setup. Our bear case shows a downside of about 11% if growth stalls, but our base case offers an upside of 42%. That is a 4-to-1 asymmetry ratio. When you combine this reverse DCF with the free cash flow yield and the sum of the parts analysis, they all point to the same conclusion. The market is vastly underestimating the staying power and the growth potential of this franchise.
Monte Carlo results.
To wrap our heads around Duolingo's true potential, we ran a comprehensive simulation, basically a Monte Carlo analysis testing 18 different probability-weighted scenarios. We looked at 3 big variables: cash flow growth, the discount rate, and terminal growth. By randomizing these, we can see how the stock performs across 10,000 different versions of the future. What we found is one of the most compelling risk-reward setups I've seen in a long time. Here's the bottom line. Only 2 out of those 18 scenarios resulted in a fair value lower than the current price of $104.84. To actually lose significant money here, you would need a perfect storm of bad luck. You'd need cash flow growth to stay under 10%, which is a quarter of its current rate, while the discount rate stays at a punishing 12%, and long-term growth remains below inflation. Even if that nightmare scenario happens, your simulated loss is only about 7% to 15%. That's not a wipeout. That's a bad quarter. Now, look at the upside. The median outcome in our model, not the best case, just the middle of the road, is $195 per share. That's an 86% gain from where we are today. If things go well and we hit the higher end of the distribution, We're looking at fair values between $273 and $359. When you weight all these probabilities together, the average fair value comes out to $230 or a 119% expected gain. The math tells us this isn't a coin flip. Based on our simulation, there's a 95% probability that the stock is undervalued at $104.84. You have a situation where the downside is nearly bounded at 15%, while the potential upside is open-ended, reaching as high as 493% in our most optimistic runs. We've looked at this from 3 different angles now. The reverse DCF shows the growth hurdle is incredibly low at just 6.4%. The break-even analysis shows that almost every realistic scenario clears that hurdle. And finally, this Monte Carlo simulation confirms that the odds are heavily skewed in your favor. You are essentially looking at a 95-5 win-loss probability on a near-monopoly franchise with $1.0 billion in cash. At this point, the only real question left is when the market wakes up to the math, because the direction seems clear.
Analyst coverage and insider activity.
Following that February 27th earnings report, the analyst community basically moved in a pack. We saw a massive wave of downgrades from 6 major firms all at once, which sent price targets into a total tailspin. Morgan Stanley, Citi, and Scotiabank all slashed their targets from the mid-$200 range down to just about $100. Evercore took theirs from $330 all the way down to $114. And just yesterday, JP Morgan trimmed their target even further, from $95 down to $92. It is really striking that the stock is currently trading at $104.84, which is actually above where most of these analysts think it should be. Right now, 12 out of 17 analysts have a hold or sell rating on the name, which shows us we are at a point of maximum pessimism. But if you look at what the insiders are doing, a very different story starts to emerge. Just a few days after the crash, Board Director James Shelton stepped in and bought $499,000 worth of stock at around $100. That wasn't a scheduled trade. That was a deliberate buy after the price collapsed. When you combine that with the new CFO authorizing a $400 million buyback, you start to see that management is acting like the business is in great shape, even if the analysts are anchored to this idea that the 2026 investment year is a problem. They are putting hundreds of millions of dollars to work at a price where our models show nearly all the outcomes favor the upside. The reality is that the market has priced in all the bad news, but it hasn't factored in any of the potential wins. We have Q1 earnings just days away, and they look like a total free call option for investors. Remember, the CFO specifically mentioned back in February that bookings were already tracking above guidance. If they beat those numbers, even by a little bit, the whole mass downgrade narrative falls apart, and all those analysts who cut to a hold at $100 will have to scramble to revisit their models. The bottom line here is that while the market is focused on a temporary investment year, the platform itself is permanent. By the middle of 2026, we'll have real data on new features like speaking adventures, video calls for the super tier, and the math app. If even one of those catches fire, the story shifts instantly from a company losing its edge to a company becoming the dominant AI learning platform. The $400 million buyback is the ultimate statement of confidence from the people who know the business best. Keep a very close eye on these Q1 earnings because everything else in this thesis follows from what we see there.
Potential upsides not included in the price and catalysts to watch.
The recent sell-off following the 2025 year-end report really boils down to one specific narrative. The market is worried that Duolingo is intentionally sacrificing short-term profits to chase daily active user growth, and they aren't sure yet if that bet is going to pay off. That is essentially the entire bear thesis. But when you look closer, it seems like everything else is being treated as a free option. For starters, you have chess and math, which are billion user markets that aren't even being priced in yet. CEO Luis von Ahn noted that there are about 1 billion people learning math globally, and Duolingo is nearly ready to launch what he calls the best math tutor app on the market. We've already seen chess hit 7 million daily active users in under a year, with almost zero optimization. Yet the market still insists on pricing this strictly as a language app. Then there's the massive potential for an AI-driven monetization unlock. Currently, only about 10% of monthly active users pay for the service, while a company like Spotify is up around 50%. Management has been very open about the fact that they have been under-monetizing by using friction as their main lever for conversion. The 2026 strategy is all about clearing that friction away. If they can move that paid conversion from 10% to just 20% on the same user base, you are looking at doubling the revenue without even needing to find a single new user. We are also seeing a structural shift in how they handle advertising that could expand margins significantly. They are replacing low-quality network ads with direct brand deals from companies like Disney, which means much higher payouts for the same number of ads. When you combine that with AI-generated ads delivered in the actual language you are learning, you have a product that no other platform can really replicate, and that definitely isn't priced into the stock yet. Another huge catalyst is moving the video call feature into the super subscription tier. Luis pointed out that there are 10 times as many super subscribers as there are max subscribers. Right now, this killer feature that actually teaches people to speak is locked behind the expensive max tier. Moving it to super gives it 10 times the distribution. Since AI costs have dropped enough to make this viable, the impact on user retention and viral growth could be massive. Finally, you have to look at the 100 million daily active user target, which translates to a business doing $2.5 billion in revenue and $700 million in adjusted EBITDA by 2028. At the current market cap of roughly $4.9 billion, the stock is trading at only 2.0 times that revenue scenario and a mere 7.0 times that EBITDA goal. For a company that effectively has a monopoly moat and 85% market share in language learning, those are incredibly low multiples for a business of this scale.
What would kill the thesis/base case?
The 5 risks that actually matter. When we analyze what could actually go wrong for Duolingo, there are 5 specific risks that really move the needle. The first is that the slowdown in daily active users might become permanent rather than just temporary. The company is treating 2026 as an investment year, betting that removing friction will bring people back. But if users have simply moved on to other forms of social media or habit drift has set in, that 100 million user goal starts to look like a pipe dream. Even the CEO admitted that the fallout from that AI memo in April 2025 caused some self-inflicted damage to their public image that hasn't fully healed yet. Another huge factor that people often overlook is how dependent Duolingo is on Apple and Google. About 82% of all their bookings run through those 2 app stores, with Apple making up 62% and Google taking 20%. Both of those platforms take a 15 to 30% cut of every dollar. If either company decides to hike fees or change their distribution rules, it would instantly wipe out a massive chunk of Duolingo's profit margins. We saw with the Epic Games lawsuit just how quickly these platform disputes can turn into a real problem for developers. Then there is the threat of AI disruption to the core habit of learning a language. While management seems confident, the SEC filings are a bit more cautious. They acknowledge that as real-time translation tools like ChatGPT's voice mode or Google Translate continue to improve, people might just feel they don't need to learn a second language anymore. If everyone has high-tech earbuds that translate in real time, the motivation to spend years studying Spanish or French could evaporate. It is an existential risk, even if it feels a bit far off right now. There is also a major execution risk tied to this 2026 monetization reset. Management is intentionally slowing down bookings growth to around 10 to 12% while they overhaul how the app makes money. They are testing things like direct ad sales and moving high-end features like video call into the super tier, but none of this is proven at scale. If we get to the end of 2026 and we don't see a meaningful re-acceleration in bookings, the market is going to stop treating this like a growth stock and start pricing it like a mature, low-growth business, which would be a painful adjustment for the share price. What kills the base case? $195. When we look at what might derail our base case of $195, it really comes down to whether the investments being made in 2026 turn out to be a disaster. For this target to fall apart, we would need to see a perfect storm where three specific conditions all happen at the same time. First, daily active user growth would have to stay at or below 20% all the way through 2027, and we will be watching the second and third quarter reports this year very closely for those signals. While 20% is exactly what management has guided for, the real risk is if that number fails to pick up as we move forward. The second part of that failure chain is if the expected re-acceleration in bookings never actually shows up in the second half of 2026. This isn't visible in the data yet, so the late-year reports are going to be a massive tell for the health of the business. Finally, all of this would have to be coupled with a failure of their current monetization experiments, specifically the rollout of video call features and the shift toward direct ad sales. We are still waiting for management to report on the results of their current A/B tests, so that commentary in the upcoming earnings calls is vital. When you weigh it all up, we think there is about a 25% probability that the base case dies, but that requires both the user growth to stall and the monetization rebuild to fail simultaneously.
Bottom line.
When you look at the big picture for Duolingo, the most striking thing is the massive gap between the business fundamentals and the recent stock price. While the stock has suffered a severe downtrend, dropping minus 69% from its all-time high of $544, the actual business performance remains incredibly consistent. Revenue is still growing between 35% and 45% year over year, and operating margins have actually expanded from 6.6% to 15.4% over the last year. We are looking at a company with a fortress of a balance sheet, holding $1 billion in net cash against less than $93.8 million in total debt. Despite these strong numbers, the market has re-rated the valuation violently. At the current price of $104.84, the enterprise value is down to roughly $3.9 billion, and the stock is trading at just 3.76 times EV to sales. To put that in perspective, this company is now being priced like a mature, slow-growing business, rather than a high-growth SaaS platform with 72.8% gross margins. Even the analyst community has moved to a point of maximum pessimism, with most firms currently at a hold and price targets clustering around the $100 mark. It is worth noting that a massive earnings beat back in Q3 2025 likely came from a one-time tax benefit or asset sale, which may have confused the trailing data, but the operational core is still very much intact. Technically, the stock seems to be coiling. We have seen 8 weeks of tight consolidation between $88 and $108, which often signals an accumulation base. Volume has dried up significantly since the initial crash, suggesting that the selling pressure has finally exhausted itself. If you are looking at an entry, this $95 to $108 zone is the current support base. On the downside, we see a very hard floor between $88 and $90, which aligns with both recent lows and our most pessimistic Monte Carlo simulations. If the stock can break above the $117 resistance level, the path opens up toward our first re-rating target at $140. The next 13 days are arguably the most important window for the stock this year, with Q1 earnings coming up on May 4th, 2026. The CFO has already hinted that bookings were tracking above their $288.5 million revenue guidance, which makes this report a potentially massive catalyst. A beat could trigger a 25% to 35% re-rating, as analysts are forced to move off their hold ratings. Longer term, we are looking at additional upside from speaking adventures in the second quarter and the launch of the Math app mid-year. While there are risks, such as a full-year guidance cut or a policy change from the Apple and Google app stores, the current risk-to-reward ratio is heavily skewed in favor of the upside. Ultimately, the trade framework here is straightforward. Entering in this $95 to $108 range offers a 1 to 5.7 risk-to-reward ratio relative to our base case fair value of $195. If the 100 million daily user thesis is confirmed, the bull case target of $300 represents an upside of 186%. With a stop loss set just below the $88 floor, The downside is capped while the potential gains are open-ended. The market has already priced in the bad news, but it hasn't even begun to account for a potential recovery.
Disclaimer. This report is provided strictly for informational purposes and does not constitute financial advice, an offer to sell, or a solicitation to purchase any securities. The author may hold a position in securities discussed. The analysis reflects independent research conducted without external compensation or existing business relationships with the mentioned entities. Please be advised that investing involves significant risk, and past performance is never a guarantee of future market results. Readers should conduct their own due diligence or consult a licensed professional before making any investment decisions based on this data. All information is sourced from public filings and is considered current only as of the date of the 21st of April, 2026.
Join the Value and Momentum portfolio. Unlock weekly market pulse and macro notes, high-conviction momentum plays, and institutional-level deep dives on AI infra, SaaS, and defense. Plus analysts, upgrades, and rising price targets, plus insider and institutional buys, plus sweep calls above ask, plus second derivative analysis by sector. Get the edge you need, led by former investment banker Denis Doroshenko, Lazard Rothschild. Our research helps you stay ahead of the curve. Subscribe to start your analysis now.